Hi, my name is Francinia Protti and I'm Southern European Unquote editor. And I'm here this morning with Jamie Richards, partner at Foresight Group, environmental investor, and also manager of Foresight's European Solar Fund. With the debate on climate change gaining traction, and in the global agenda, we're also seeing a lot more interest on clean tech investments and renewable energy as well. Is that something that's new, or is it something that happened a while back, and how has that evolved over the last decade?
I think we saw at the end of the tech boom, the start of the growth, the real growth in clean tech investing. A number of, particularly in the US, tech investors switched their attention towards clean tech because a number of the investment management skills required were very similar, selecting clean technologies as opposed to perhaps IT technologies that would ultimately result in more efficient ways of generating cleaner power, for example, battery technologies, even wave or tidal type technologies. From our perspective, we saw that the opportunity for us was probably better in the infrastructure part of that sector, which is putting the established bankable technologies to work.
So let's focus then on the clean tech investments. What does it take to really be an interesting player in this space?
Yeah, I think the infrastructure part of the market is traditionally the domain of large utilities investing in power projects or large infrastructure funds. What we're seeing in the renewable sector is a much more fragmented market. In the solar sector, for example, project sizes are limited to a size where it's more the more attractive incentive levels are for the smaller projects. The smaller projects typically are too small for either the large utilities or the large infrastructure players to look at. So we're consolidating and aggregating a number of projects in the sectors that we look at to create a portfolio size that is then attractive to a utility or infrastructure fund acquirer. And we're able to manage those smaller transaction sizes in a way that also delivers a return profile that's attractive to our investors.
Considering the Foresight approach, you offer really interesting returns to LPs. But do you think that the debate on climate change has also rendered it interesting to LPs?
Yeah, for sure. The LPs now traditionally have had allocations for income and growth. The renewable infrastructure sector plays very well to investments in that income allocation. And so we're seeing that they recognize that exposure to renewable infrastructure is, from their perspective, something that can offer them the right level of returns as well. And the way that we structure our investments and the strategy of the fund is such that it plays very well to either complementing or replacing some of the traditional investments that they made within that allocation. For example, by working in a way that minimizes construction risk or does away with development risk within a solar project, for example. This can be structured in a way that has a similar risk profile to traditional infrastructure assets, but generates a higher return because of the incentives currently in place for generating renewable energy.
Is the current climate affecting how quickly LPs go through the due diligence, for instance, and assess whether or not they want to allocate funds to a particular fund or not?
We're finding still that a number of LPs are trying to understand which renewable sector to get involved with. Now, we think it's easy to demonstrate which sectors they should be involved with depending on whether they're allocating from their private equity growth allocation or their income allocation. And from the perspective of getting them to the point where they feel they understand which sectors have risk profiles that fit one or other category. then that's something that we're currently spending some time on, because they know they want to invest in the sector, they know they can get the right risk profile, but with regard to the subsectors, they're trying to understand the right mix that they should be going for.
And as a fund manager, are you finding that oversubscription can still be a risk right now? Could LPs at some point default on their commitments because of lacking liquidity?
Well, we're finding that the LP environment is slowly becoming more liquid, but it takes a long time to get to the point where they're happy with their due diligence and they can make the commitment to the fund. And that's partly been made worse over the last 12 months because of the credit issues in the market and the reluctance for people to move on very much at all.
And let's go back now to Copenhagen. And could you tell me, if anything were to come out of it, what it should be?
I'd like to see more progress made. I don't think we'll have any kind of definitive outcome, but certainly more progress made in the carbon market. That's a market where it's a more complex sector to provide mechanisms for encouraging investment, partly because of the multi-jurisdictional nature, and needing to find some way of ideally bringing a lot of that together. But in the absence of any unified mechanism, typically countries are setting up their own solutions, which make it much more difficult for an international carbon developer or carbon monetization organization to work. So anything that simplifies the process of providing more liquidity to the carbon market would be a good thing.
Thank you for joining us, Jamie. And this is Francinia Protti signing off from OnQuote.